your name and where you're from first, please.
Scott Irwin, University of Illinois, home of the Fighting Illini.
And it's our 150th anniversary today.
Amazing.
150 years.
I am proud to be part of this place.
Absolutely. I know, and I know you're not saying that sarcastically. I think we're both.
No, I mean that sincerely. This is my dream job.
Mine too.
So we're both very, very fortunate men.
Kind of fun. I looked at the markets today. Beans jumped 30 cents. Corn was up 14 to 15. Wheat up 12 to 14. It all happened based on a set of rumors that's coming out of Washington, D.C. The Trump administration, by executive order, I guess, at some point we'll see, may very well move the RINs market around a little bit, and this has to relate to where ethanol is blended. Can you tell me what's happening?
Well, as best as we know, we're all just dealing with rumor at this point. So I have seen nothing on paper except what's being reported over the wire services that I follow. So my comments will be based on my limited information. But what I know at this point from what's being reported is that, number one, that President Trump will issue an executive order that will change the point of obligation for the RFS from refiners and importers of transportation fuel to blenders of transportation fuel in the United States. And that's what Mr. Carl Icahn, one of Trump's advisors, has been after in a very public way for quite some time.
Now, he has a vested interest in this, I believe.
Yes, he's a major owner of a refinery, CVH?
Something along those lines.
Yeah,
I don't quite remember.
CVR, CVH.
I think it's CVR.
I think it is CVR, is right. Yeah. And his argument has been, Todd, that so-called merchant refiners, like the one that he has an ownership stake in, have been badly disadvantaged by the RFS because they have to buy these expensive RIN credits for compliance with the RFS, and that this is a huge cost to them, and it is really hurting their bottom line, particularly as RINs costs in recent years have risen with the price of RINs. That's his argument.
These are just a paper item.
That's right. The RINs themselves are simply the credits that obligated parties under the RFS must turn in to comply. And those RINs are created when a biofuel is manufactured. It's a number. And originally it was a 36-digit number. RIN stands for Renewable Identification Number, and it travels with the biofuel all the way to the consumer when it's finally used and extinguished. And so you have to turn in for compliance, if you're an obligated party, and on an annual basis, a set number of these RIN credits, 1 credit per gallon. And Mr. Icahn's argument is, since his refining operation doesn't have any upstream blending assets, that he doesn't have any way to obtain the RIN credits by blending.
And so he has to buy them on the open market.
Exactly.
So he buys the ID, the RIN, on the open market to prove that, yes, when I shipped, it did, in fact, have a gallon or E10 or ethanol, biofuel, whatever it happens to be in the final product.
But the tricky part is the way this program was set up is, his company literally never blends.
Right.
Even though it is truly a blend mandate. It's a blending mandate. You have
Right.
to have so much of this in the final fuel that consumers consume.
And he can say he blends by buying.
That's exactly how
Right.
the program is designed
And the
to
mandate,
work.
and so they're there so that when you have a company like Icons, it can go ahead and buy it, say yes, I met the mandate because somebody else overproduced and I was able to buy their extra RINs, relatively speaking.
That's exactly right.
Okay.
So that's how it works in
And
a mechanical sense.
and so he's been a big supporter of moving this somewhere else down the line. Will it work?
No, he's dead wrong, and it's unusual for an economist to be this certain, but I am absolutely certain on making that statement. And the reasoning is very simple. Let me put it to you this way, Todd. We already have a lot of experience with gasoline taxes. Our current system levies the sales taxes on gasoline at the retail level, right? And so the firms where you pull up to pump your gas, they have to pay a tax for the gallons that you buy. Now, do they just say, oh my gosh, that's a lot of money, 40, 50 cents in gas taxes, whatever it is, and we're just going to absorb it and it'll drop our bottom line? No. What do they do, Todd? There's a word the economists have. It's called pass-through. They raise the retail price to offset the sales taxes that are collected from those firms, but who's really paying the tax? Todd is raising his hand right now, and I'm raising my hand. Consumers, of course we pay for it. It's passed through ultimately to the consumer. RINs work exactly the same way. Mr. Icon's company has to buy those RINs. And yes, it does. It shows up as an expense on his refiner's income statement. No doubt about that. But what we know, what does economics predict? And you don't have to have market power to do this. It's just in a competitive market, then that firm wouldn't survive, presumably, if they didn't raise the prices for the petroleum gasoline feedstock that they sell out of the pipes of their refiners. And so they raise the price in order to offset the RINs that they're buying, and their bottom line margin is unaffected except for administrative costs that are involved with the compliance aspects of the RFS. Otherwise, it's a wash. So now, if you move the point of compliance, what you should see is Mr. Icon's refinery, the RIN expense will go off the income statement, but he'll also be selling at a lower price his petroleum feedstock. And so it's a wash, except for those administrative costs, which it's hard to imagine that those are really huge.
But doesn't he think he'll sell more of his gallons because of this?
Well, he may, but he's not going to.
Why not?
Because basically it has to do with the demand for gasoline is extremely inelastic in the short run in the United States, which means that the quantity effects of all this are very, very small. And so this is not just one, academic economist spouting this off. So the logic of what I've explained, I think most people can understand, which is a RIN is to that refiner is a tax. It is. Nobody's going to argue with that. What happens with taxes in a supply chain? They're like a hot potato. They will get passed on ultimately to the consumer. And we have very good empirical research right now that shows, excuse me, that's exactly what happens, Todd. A colleague that I know of at a couple at Harvard James Stock has a paper that very rigorously examines this issue and shows that, yeah, it works pretty much like your intuition would say.
Could this have an impact on the ethanol producer in any way?
No,
Same thing for them. Doesn't matter where this gets taxed.
everything just shuffles around. The prices will adjust. There can be a little short-term dislocation as people try to figure out a new system. There can, be some small impacts based upon market position and where your particular assets are located, in a logistical sense. But these are small impacts in the overall system.
And it won't, as some have argued, make it more difficult to manage the RINs themselves?
Well, now that to me is the really interesting point of where this is going, is exactly how are they going to define a blender instead of a refiner. A refiner is pretty easy to identify. It's a huge plant. You can't hide a refinery, right? But exactly who's a blender when you have a pipeline system, and exactly that will be interesting to see how they thread that needle. But I presume that it can be done. My prediction is that this will actually make the administrative cost of complying with the RFS overall for the U.S. economy more expensive. I don't see how you can have fewer obligated parties and fewer people trying to comply under a blender point of obligation. But essentially, that's the only impact that this particular part of the announcement should have.
Okay, so there were three things, all rumored until something else happens, that are moving the market for the day. The first is where that blender tax slash possibility will happen, moving it out of the refinery to someplace else. The second is that part of the deal may or may not be that the administration will push E15. I suppose that certainly could be good for the corn market over the long run. And then the third part, which I think you find most interesting and that you talked about last year in 2016, is the tax credit for biodiesel and qualifying it as a U.S. only tax credit. Is that the big one?
That's the big one, Todd, if it's a part of the deal. I have not seen that confirmed, but what we know is that biofuels and ag interests have been pushing hard on that conversion. Very hard. Senator Grassley first introduced that in the summer of 2015, and he didn't get it done when the biodiesel tax credit was extended. A larger group has come back to try to get that conversion accomplished. I talked to, after the election, I think you and I had talked, and I thought this would be something that people should be on their radar because it would be very attractive to President Trump, given his America First orientation. So, probably helpful to explain, how does the biodiesel tax credit work right now? It's expired right now, but it's probably going to be reinstated. It always is. The way it has worked in the past is that, intriguingly enough, that is a blender credit. So we've got things going in opposite directions here. And that means that blenders can, as long as they're blending a gallon of biodiesel into petroleum diesel, they can get a $1 per gallon tax credit to offset the cost of blending the higher priced biodiesel. But here's the interesting part of that is it doesn't matter where it comes from. Since it's a blender credit, you can get the biodiesel from the United States biodiesel producer or from anyone outside the U.S. And with the burgeoning advanced mandate, we have been sucking in biodiesel imports at a really rapidly growing rate, particularly in 2016. I have got to get the final numbers when they're in, but it's going to be huge. So, basically the marginal gallon to comply with the RFS, Todd, has been coming from Argentina recently because of the way the tax credit works. That's what's been happening. And so this proposal, and if it's true, would then make the tax credit it has to be produced on U.S. soil to be eligible for that tax credit, which means effectively it would put Argentine and any other biodiesel producers at a $1 per gallon price disadvantage, which would be very hard to overcome. And so I think that what the market's reacting to is probably two things. One is the potential for this conversion to a tax credit, if that's what's going to happen, because that means that based on what's happened in the past, that compliance for the advanced component of the RFS and the part of the ethanol mandate above the blend wall just got a lot more expensive. And then secondly, and something that I've been arguing since the election, I think the market is waking up to the fact this is going to be a huge shock, and it's a support. The Trump administration is not going to touch the RFS. They're going to support biofuels, which is what I have always thought would be their natural position. And there's a lot of people that have been building positions into the RINs market and into grain markets, basically having a bearish view on what might happen with RFS reform, with Icahn and Pruitt being the point people in the RFS. And that's another key point in this. As it's being reported, what we're seeing, it's very important. I see headlines saying RFS reform. It is not RFS reform. RFS reform requires the U.S. Congress to change the legislation. That obviously is not happening, and you cannot change the legislation by executive order. All you can do is change some features related to the implementation of the RFS. And that's basically all that's going on.
Thank you.
All right, my pleasure. I'm sure we will probably be talking more about this in future days.
I am positive that is the case. Scott Irwin, of course, is an agricultural economist here at the Urbana-Champaign campus of the University of Illinois. I'm U of I Extension's Todd Gleason.